Hello, class. Chapter 20 is about master budgets and planning. We're going to talk about cash budgets and production budgets and the benefits of budgeting and planning. Managers must ensure that activities of employees and departments contribute to meeting the company's overall goals. So, budgeting is the process of planning the future business actions and expressing them as a formal plan. A budget is a formal statement of a company's plans, expressed in dollars. Unlike long-term strategic plans, budgets typically cover shorter periods, such as a month or a quarter or even a year. The budgetary control process involves 4 steps. First, develop the budget from your planned objectives. Second, compare actual results to budgeted amounts and analyze the differences. Third, take corrective action and strategic actions. And fourth, establish your new objectives and a new budget. So that's kind of your whole cycle for the budgeting process. So budgets benefit the key managerial functions of planning and controlling. So let's go over these. Plan. A budget focuses on the future opportunities and threats to the organization. This focus on the future is important because the daily pressures of operating an organization can divert management's attention from planning. Budgeting forces the managers to plan for the future. Control. The control function requires management to evaluate, benchmark operations against some established norm. Because budgeted performance considers important company, industry, and economic factors, a comparison of actual to budgeted performance provides an effective monitoring and control system. This comparison assists management in identifying problems and taking corrective action if necessary. Budgeting also helps to coordinate activities so that all employees and departments understand and work toward the company's overall goals. For example, your sales budget might look different than your cash budget, right? And 2 different departments could be in charge of those 2 different budgets. However, at the end of the day, the company's goal would be the same, to maximize earnings. That's just kind of like a high-level example. And communication, written budgets effectively communicate management's specific action plans to all the employees. When plans are not written down, conversations can just lead to uncertainty and confusion among the employees. So it's always good to have a written budget. Frankly, most companies require a written budget. Motivation. Budgets can be used to motivate employees. Budgeted performance levels can provide goals for the employees to attain or even exceed. Many companies provide incentives like cash bonuses for employee performance that meets or exceeds their budgeted goals. Generally, the budgeting process has 3 important guidelines. First, the goals reflected in a budget should be challenging but attainable. Second, the employees affected by a budget should be involved in preparing the budget. This is also called participatory budgeting. And third, evaluations offer opportunities to explain differences between the actual and budgeted amounts. However, management has to consider that there are some negative impacts of participatory budgeting. For example, the pressure to meet the results can cause employees to engage in unethical behavior or commit fraud. Remember, that's part of the fraud triangle. Employees may understate sales budgets and overstate expenses to allow a cushion. That's called budgetary slack. And employees might spend their budgeted amounts, even on unnecessary items, just to make sure that they don't get a reduced budget for next period. So these are things that cause management to make sure that there are controls in place, kind of like checks and balances, to make sure that they can prevent these things as much as possible. when I did my work as an auditor, this is one of those really important things that we would always make sure that the company had controls in place. The budget period is usually tied to the company's fiscal year. To help control operations, the annual budget can be separated into quarterly or monthly budgets. These short-term budgets allow management to periodically evaluate performance and take timely corrective action. Many companies will apply continuous budgeting by preparing rolling budgets. In continuous budgeting, a company continually revises its budgets as time passes. In a rolling budget, a company revises its entire set of budgets by adding a new quarterly budget to replace the quarter that just elapsed. Thus, at any point in time, monthly or quarterly budgets are available for the next 12 months or 4 quarters. Let's look at how companies prepare the operating budgets of a master budget. And we're going to use an example of a manufacturing company. A master budget is a formal, comprehensive plan that contains several interconnected budgets. So Exhibit 20.2 here summarizes the master budgeting process. The process begins with the sales budget. The master budget includes individual budgets for sales, production, or merchandise purchases if you're not a manufacturing company, expenses, capital expenditures, and cash. The process ends with preparation of the budgeted financial statements. So this chapter in your book explains how Toronto Sticks Company, a manufacturer of hockey sticks, prepares its budgets. Its master budget includes operating, capital expenditures, and cash budgets for each month in each quarter. It also includes a budgeted income statement for each quarter and a budgeted balance sheet as of the end of each quarter. We show how TSC prepares budgets for October, November, and December. So here's Exhibit 20.3, and it shows TSC's balance sheet at the start of the budgeting period, which we referred to in preparing the component budgets. So as you can see, make sure you're paying attention to the dates when you see schedules like this. This one is September 30th, so it's the end of the last budgeting period, which, like we said, is the beginning of our budgeting period that we're going to be looking at. So September 30th ending balance sheet is the same thing as your October 1st opening balance sheet. The first step in preparing the master budget is the sales budget, like we said. So it shows the planned sales units and the budgeted dollars from these sales. The sales budget is the starting point in the budgeting process because many costs, like variable costs, will change with sales. So the sales budget comes from the analysis of forecasted economic and market conditions, business capacity, and advertising plans. So TSC sold 700 hockey sticks at $60 per unit in September. After considering sales predictions and market conditions, TSC prepares its sales budget for the next 3 months and the 3-month total, which would be the quarter. The sales budget in Exhibit 20.4 includes the forecasts of both units and sales prices. Okay, so a manufacturing company will prepare a production budget. This shows the number of units to be produced in a period in order to meet the budgeted sales and the desired inventory levels. Manufacturers will often set what we call a safety stock, and that's just the quantity of inventory that they need to keep that will help protect against lost sales if it's caused by unfulfilled demands from customers or delays in shipments from suppliers. So Exhibit 20.5 shows you how to compute the units to produce for a period. Now, a production budget is not going to show you the dollar cost. It's always expressed in the units of product. This slide depicts the general computation for the production required for a period. We start with the budgeted ending inventory. Then we add the budgeted sales units for the period, and that came from the sales budget. This will give us the required units needed for the period. Then we subtract the number of units in the beginning finished inventory to get the total units to be produced in the period. Starting in October, TSC decides that the number of units in its finished goods inventory at each month end should be equal to 90% of next month's budgeted sales. So for example, the inventory at the end of October should equal 90% of the budgeted November sales, and so on. We can now prepare the production budget in Exhibit 20.6. The production budget can be viewed in two parts. First, total required units, budgeted sales units plus desired ending inventory units. Second, units to produce, the total required units minus the beginning inventory units. This budget reports units to produce each period. Your units to produce is the basis for your manufacturing budget for direct materials, direct labor, and overhead, which we'll talk about next. So let's just look at this production budget again in a little bit more detail. So let's just look at October. So we have our budgeted sales units. So we know we need to sell 1,000 units, and that came from our sales budget that we talked about earlier. And then we know that we want our desired ending inventory balance to be 720 units. So we know that if we want to sell 1,000 and we want the ending to be 720, well, that means our total required units for October is just the sum of those two. So that's the 1,720 here. And then if we already have 1,010 on hand, so that's why it says less the beginning inventory units, we already have that many on hand. So that means we can subtract that to get to 710, and that's how we know that's how many we're lacking in October. We need to produce 710 in October. And then you'll notice with these arrows here, your desired ending inventory, that just comes over to your next month, and that's your beginning inventory. I like to think about it logically like that and just run through it rather than just like memorizing the formulas. Okay, so the direct materials budget shows the budgeted costs for direct materials to be purchased to meet the budgeted production. Whereas the production budget showed us units to produce, the direct materials budget will translate those units to produce into budgeted costs. So first, let's figure out how you calculate materials to be purchased. Materials to be purchased is computed by multiplying the units to be produced times the materials required per unit, plus the desired ending materials inventory minus the beginning materials inventory. So here's our direct materials budget. It shows the budgeted costs for the direct materials that must be purchased to meet the budgeted production. Whereas the production budget showed units to produce, like we said, the direct materials budget is now translating those units into budgeted costs with the dollar amount. So Exhibit 20.7 shows the direct materials budget for TSC. And they have 5 steps to prepare it. First, enter the units to produce from the production budget that we did a couple slides ago. Second, enter the materials required per unit. For TSC, this is 0.5 pounds of wood required per unit. We then compute the materials needed for production. So for October, we take the 710 units to produce that we calculated and multiply it by the 0.5 pounds to get 355 pounds. So now you're going to add your desired ending materials inventory. For TSC, its policy starting in October is to have ending materials equal to 50% of next period's materials needed. So this works out to be 335 pounds for October, which is just 50% of 670. So see, you need to do this first step across each of the months so that you can calculate like we calculated the 670 because we knew that the 1340 was the units to produce for November times the 0.5, which is the half pound of wood needed. So that's how we got the 670, and that's how we can come back here and keep moving down the steps for October. Okay, then the final step, step 4, is subtract the, I'm sorry, that's not the final step. Step 4 is to subtract the beginning materials inventory for TSC. This is 178 pounds. for October from Exhibit 20.3. We then compute the materials to purchase, which is 512 pounds, and that's the 690 minus the 178. So let's come down here and look at that again, similar to how we did on the production budget. So we have the materials needed to produce. We got the 355, right? Because that's the amount of wood we need to meet our units to produce. Okay, now we know that our desired ending inventory is the 335. We just calculated that. So that means if we know we need 355 to produce in order to meet the requirement for our sales budget, but then we also know that we need to end with the 335. So we add those together, which means we need the 690 pounds of wood total. But we already have, how many do we have on hand? So our beginning materials inventory was 178. So that's why we're backing out that amount, because we already have that on hand. And that's how we get down to our materials to purchase, the 512. So now the final step is we need to translate it all to dollars, right? So we enter the materials cost, and the materials cost is $20 per pound. So when we compute the cost of direct material purchases as 10,240, and that's just the 512 pounds of wood times the $20 cost per pound. Okay, so remember that another component of the cost of inventory is direct labor. So the direct labor budget shows the budgeted cost for the direct labor needed for the budgeted production for the period. To develop a direct labor budget, companies need the following inputs. First, the number of units to produce from the production budget like we just went over. Then you need to know the labor requirements per unit, direct labor hours for each unit of finished product. Then you need to know the cost per the direct labor hour. All right, so Exhibit 20.8 shows the direct labor budget for TSC, and it has 3 steps to prepare it. First, enter units to produce from the production budget. Next, you enter the labor hours required per unit. For TSC, this is a quarter of an hour. We then compute the direct labor hours needed. For TSC, we multiply the 710 units to produce in October times the quarter of the hour, and that gets to 177.5 hours needed. Then finally, third, you enter the labor cost per hour. For TSC, the labor cost per hour is $12. So we then compute the cost of direct labor as $2,130, and that's the 177.5 hours times the $12 per hour. Now, you might be wondering, where does the direct labor per the quarter of an hour per unit, where does that come from? That's usually going to be given to you, and that's usually in the real world, that's going to come from, experience and reports that show that we know, based on our history and based on running the production, we know that it takes a quarter of an hour. And then the direct labor cost per unit, per hour, that's also going to be given to you. And in the real world, that comes from something like payroll, or some kind of record that shows this is how much we pay someone for their direct labor, directly working on that production. Okay, now let's look at the factory overhead budget. Remember, that's another component of costs of inventory. Now this shows the budgeted cost for factory overhead that will be needed to complete the estimated production for the period. TSC separates variable and fixed overhead costs in its overhead budget, as do many companies. This exhibit 20.9 shows the factory overhead budget for TSC, which has 3 parts. First, compute the budgeted variable overhead. This is the direct labor hours from exhibit 20.8 that we just looked at, multiplied by the variable overhead rate per direct labor hour, or 177.5 times $10 for October. Okay, second, you compute the budgeted fixed overhead. So TSC's fixed overhead consists entirely of depreciation on the manufacturing equipment. And from exhibit 20.3 that we looked at the beginning, this is $18,000 per year, $200,000 minus $20,000 divided by 10 years, or $1,500 per month. $18,000 over 12 months. That's how you get the $1,500. So then third, you just compute your total budgeted overhead, which is just the total of parts 1 and 2. Now, variable cost items commonly include indirect materials, indirect labor, factory utilities, and maintenance of manufacturing equipment. Fixed cost items commonly include supervisor salaries, depreciation expense, and property taxes. So we cover overhead budgets in detail in the next chapter. So the thing I would tell you to pay attention to here is notice that we calculated the budgeted variable overhead based on an amount that's like it's the rate per direct labor hour. It's not the rate per unit. So you'll notice down here there's a little comment that says the variable portion of factory overhead is assigned at $250, but that's because that's $250 per unit of production. And like we said, we'll talk about the overhead in more detail in the next chapter. So now with the 3 manufacturing budgets that we just did, the direct materials, direct labor, and factory overhead, we can compute TSC's budgeted product cost per unit and prepare a cost of goods sold budget. So Exhibit 20.10 summarizes the product cost per unit calculation. The cost of direct materials came from Exhibit 20.7, and the cost of direct labor came from Exhibit 20.8. And then remember the $250 is the predetermined variable overhead rate from Exhibit 20.9. So to compute the product cost per unit for fixed overhead, we noted that TSC expects to produce on average 1,000 units per month, which means that its fixed overhead per unit is $1.50. So that's the $1,500 divided by 1,000 units. So now our total product cost per unit is the sum of all of those, which is $17. So now the budgeted product cost per unit can be used to prepare the cost of goods sold budget. We use the budgeted sales units from Exhibit 20.4 multiplied by the budgeted cost per unit that we just calculated from Exhibit 20.10. So in October, we've got the 1,000 units. That's how much from the sales budget that we said we're going to sell in October, right? And then times the $17, that's what we just calculated. So for October, our budgeted cost of sales is $17,000. So now we keep moving down the income statement lines. We got the sales, we got cost of sales. Now we're on selling expenses. The selling expense budget shows the types and amounts of selling expenses expected during the budget period. TSC selling expense budget is in Exhibit 20.11, and its selling expenses consist of commissions of 10% of total sales paid to sales personnel, and a $2,000 monthly salary paid to the sales manager. So sales commissions vary with sales volume, but the sales manager's salary is fixed. Other common selling expenses include advertising and delivery expenses. And so I like to think about selling expenses differently from cost of sales because selling expenses, they're still related to sales, right? So they can be based on sales. Like the 10% commission, that's going to be a calculation based on sales, but they don't actually go into the production of the unit. And so that's how you can remind yourself of the difference on the income statement of cost of sales, which are the costs that actually go into production, versus the selling expenses, which go below the gross profit line. They go below sales and cost of sales on the income statement. But they're still related to sales. Okay, so now we're down to the G&A expenses. So the G&A expense budget reports those expenses expected during the budgeted period. Exhibit 20.12 shows TSC's general and administrative expense budget. It reports the administrative salaries of $4,500 per month. Other common examples of G&A expenses would include property taxes, office expenses, insurance and depreciation on non-manufacturing assets, So for example, depreciation of your office building or of your computer equipment, that would go under G&A expenses. Okay, we talked about the production budgets. Now we're going to switch gears and we're going to talk about specifically the cash budget for a manufacturing company. The capital expenditure budget reports expected cash receipts and cash payments related to the sale and purchase of plant assets. So like your property, plant, and equipment, PP&E as you might have heard it called. The capital expenditures budget is usually prepared after the operating budgets. The process of preparing operating budgets can reveal that the company requires more or less sometimes in plant assets. So this slide includes the capital expenditure budgets for TSC. TSC does not plan to dispose of any plant assets through December, so through the end of the year, but it does plan to buy equipment for $25,000 cash in December. So a cash budget also is going to show the budgeted cash receipts and cash payments during the budget period. So this is also called a financing budget. Managing cash flows is vital, and a cash budget helps with that task. Most companies set a minimum cash balance to have available. If the cash budget indicates cash is low and it's falling below the minimum, the company can arrange for additional loans. If the cash budget indicates the cash is above the minimum, the company can plan to either pay off loans or maybe invest that cash for additional income. When preparing a cash budget, you add the budgeted cash receipts to the beginning cash balance and subtract the budgeted cash payments, just like in Exhibit 20.13 shows. Okay, now let's look at budgeted cash receipts from sales. So managers use the sales budget combined with the knowledge that they have about how frequently customers pay on their credit sales to budget for monthly cash receipts. So think about it, when you sell something to a customer, sometimes they're going to pay with cash directly right there, right? But sometimes they're not. Sometimes they're going to buy something on credit, and that's how you end up with accounts receivable. So the management will do an analysis. So for TSC, the analysis of past sales indicates that 40% of sales are paid with cash, while the remaining 60% are paid with credit. So these customers are expected to pay in full in the month following the sales. So think about how that impacts your cash receipts during a certain period. So for example, in October, their budgeted cash receipts consist of $24,000 of October cash sales. So these are the sales that were made in October and they received cash for. So that's October sales, $60,000 times 40%. Then you have to add in the collected cash that came from September sales. But remember, 60% is on credit. So you take September sales of $42,000 times the 60%, and that's how much cash you expect to come in October, even though the sale was made in September. But those were the ones that were paid on credit, and you don't expect to receive the cash until the following month. So now let's consider the timing of collection when the credit sales are received across several periods, which is more realistic. When credit sales take several periods to collect, the collections from prior periods reflect the multi-period collection pattern. For example, if TSC collects credit sales over 2 months, such as 80% of credit sales in the first month after the sale and 20% of credit sales in the second month after the sale, then the cash sales remain at 40% of the current sales. Then the budgeted cash receipts for December are shown here. But now you also have to consider uncollectible accounts. So let's consider that uncollectible accounts are 5% of credit sales. So for the remaining 95% that are collectible, assume again that TSC collects 80% of their credit sales in the first month after the sale and collects 15% of the credit sales in the second month after the sale. So the schedule of cash receipts for December is shown here. And managers prepare a schedule of cash payments for direct materials. To do this, managers must know how much direct materials are purchased, with cash or on credit, and if on credit, when payment is made. TSC's materials purchases are entirely on credit, so it makes full payment in the month following its purchases. Using this information, the schedule of cash payments for direct materials is shown here in Exhibit 20.15. Payment of materials over several periods. So when payment for materials occurs over several periods, the payments for those prior periods reflect the multi-period payment pattern, just like we did with cash receipts, only it's on the payment side. So for example, if TSC pays for 20% of purchases in the month of purchase and pays for 80% of purchases in the month after, then its schedule of cash payments for direct materials is as shown in the bottom part of this slide. So now to bring it all together and prepare the cash budget. To prepare the cash budget, managers use the cash receipts and cash payments from several budgets and schedules. Exhibit 2016 shows the cash budget for TSC. The company begins October with $20,000 in cash. See Exhibit 20.3 at the very beginning. We then add $49,200 in cash receipts from customers. We then subtract $43,565 in cash payments for direct materials, direct labor, overhead, selling expenses, general and administrative expenses, and income taxes due and paid in October. A few additional points about TSC's cash budget. The fixed overhead from depreciation in the factory overhead budget does not require a cash payment. Therefore, it's not on the cash budget. Other fixed overhead, such as payments for factory, property taxes, and insurance, are included if they require a cash payment. It announces plans to pay $3,000 of cash dividends in November. It sets a minimum cash balance of $20,000 at each month end. If TSC borrows cash, it must pay 1% interest per month. The October 31st preliminary cash balance is $25,635. Now this is before any loan activity. This amount is more than the $20,000 minimum. So TSC uses the excess cash, $5,635, to pay off a portion of its loan. So looking at November, TSC's preliminary cash balance is $43,246, and its $23,246 excess is sufficient to pay off its entire loan balance. So now let's look at the cash budget and the loan activity. So if the cash balance exceeds $20,000 at month end, remember TSC uses the excess to repay the loans. If the cash balance is below $20,000 at month end, TSC takes out a loan for the shortage. Interest on the loan is computed as the beginning loan balance times the interest rate. Using TSC's interest rate of 1% per month, the budgeted cash payments for interest follow and are reported in Exhibit 2016.